It's Friday night. You're at the ATM. The screen flickers, then it goes black. Not out of service. Not try another machine. Just black. A line forms behind you. People whisper. Someone laughs. A guy says, "It's probably just a network issue." And you feel it. That cold, tight pull in your gut. Because this isn't a glitch. It's a warning. Liquidity. When liquidity flows, life feels normal. Swipe, sell, wire, pay. You don't think about the plumbing. You don't think about the pipes behind the wall. But when liquidity freezes, normal becomes theater. Your balance becomes a suggestion. Your account becomes a request. Your money becomes a promise you have to redeem. And the rules? They can change overnight. They always do. Here's the lie they fed the sleeping herd for decades. Markets are deep. Banks are strong. There's always a buyer. Your retirement is safe. Don't worry, the government has safety nets. But nets have holes, and in a stampede, nets tear. The awakened few don't watch speeches. They watch signals. 3 signals. 3 signals that tell you the dealers and the heartbeat of the financial system are out of oxygen. Dealers aren't your local teller. Dealers are the giant firms that stand between governments, pensions, banks, and markets. They buy the bonds. They warehouse the bonds. They make prices in bonds, stocks, derivatives. They provide liquidity. That phrase is a bedtime story because dealers don't do it with their own cash. They do it with borrowed cash, overnight cash, daily cash, a treadmill. And when the treadmill stops, the runner flies. So listen, 3 signals, 1 hidden mechanism, 1 trap, and 1 exit. Because the question is simple. What breaks first? The entire system is a promise chain. You deposit money in a bank. The bank turns that deposit into loans and bonds. Your deposit is their liability. Their assets are someone else's promise. Your brokerage statement, a promise chain too. A custodian, a clearinghouse, a market maker, a settlement system, a regulator, a stack of should be fine. And every link depends on confidence, not hope. Confidence. When confidence cracks, the chain starts to rattle, and the dealer class is the central link. They are the shock absorbers. But shock absorbers don't absorb forever, not when the road is nothing but potholes. Debt is the pothole. Debt that keeps growing. Debt that must be refinanced. Debt that needs constant buyers. And those buyers? Dealers, until they can't. Now let me tell you something the corrupt system will never say out loud. Liquidity isn't money. Liquidity is trust. It's the belief that if you want out, you can get out. Fast. At a fair price. Without begging. The moment people start doubting that, liquidity dies. Not slowly, suddenly, like a light switch. That's why the system fights panic more than it fights inflation. Because inflation hurts quietly, but panic moves fast. Panic creates exits, and exits kill a promise machine. So they do 2 things. They distract the herd, and they tighten the gates. Now let's talk about the 3 signals, the ones the awakened watch while everyone else scrolls headlines. Signal number 1 is emergency oxygen. When funding is easy, dealers don't beg for help. They don't need backstops. They don't need special facilities. They fund themselves privately and quietly. But when funding tightens, they lean on emergency plumbing. They start paying up for cash. They start hoarding collateral. They start treating safe as fragile. That's the system wheezing. Think of it like this. A healthy person doesn't carry an oxygen tank. A sick person does. If you see the oxygen tank appear, you don't ask, why? You ask, how bad is it? And here's the part nobody tells you. Emergency tools are often temporary. They expire, they get shut off, they get replaced, meaning the next time stress hits, the machine has fewer cushions, less slack, less mercy. So if you're waiting for the government to save you with a magic button, understand this. The magic buttons are political. They get delayed, they get debated, they get restructured. And in a fast-moving freeze, delay is death. Signal number 2 is spreads widening. A spread is the gap between what a dealer will pay you and what they'll sell to you for. In calm markets, spreads are tight. It feels smooth, like a well-oiled door hinge. In stressed markets, spreads widen. The hinge squeaks, the door sticks. Because dealers protect themselves. They don't say, we're scared. They quietly change the price, they pay you less, they charge you more. They pretend it's normal market conditions. It's not. It's fear with a receipt. Think of a pawn shop. Calm day, fair offer. Panic day, half price. Same item, different fear. That widening spread is fear turned into a fee. A silent tax on anyone who needs liquidity right now. And retirees need liquidity. You need to pay bills. You need to live. You can't diamond hands your groceries. So widening spreads are a direct hit to your lifestyle. Not your ego, your lifestyle. Signal number 3 is physical strain, not a chart, a phone call. A delay, a dealer says, we can't lock the price. They say, back order. They say, premiums changed. They say, we're waiting on supply. That's the real world leaking through the paper world, because paper can be printed, paper can be pledged 10 times, paper can look abundant. But metal? Metal has to be found, refined, moved, delivered. And when the financial system gets stressed, the physical system becomes conservative. Inventory becomes dangerous. Hedging becomes expensive. Financing becomes tight, so they stall, they ration, they change terms, they make you wait. Now let's expose the hidden mechanism behind all three signals. Repo, repurchase agreements. This is the engine room. A dealer needs cash. They pledge bonds as collateral. They get cash. They promise to buy the bonds back tomorrow. Then tomorrow again. It's daily refinancing. Imagine owning a house, but your mortgage resets every morning. Every morning the lender decides if you get to stay. That is modern finance, and it gets worse because the dealers are leveraged. Leverage is not evil. It's just dangerous. It's like driving fast. Fast feels great until the road is wet, until there's fog, until someone slams the brakes. Then fast becomes a crash. Here's the math the sleeping herd avoids. A dealer buys $100 million in safe bonds. They don't pay $100 million. They post a haircut, maybe 2%, so $2 million down. The other $98 million is borrowed overnight. Now fear rises, haircuts rise. Now it's 5%. Same bonds, same dealer. But now they need $5 million posted. They must find an extra $3 million in cash right now. So what do? They sell other assets. They stop making markets. They widen spreads. They pull bids. They demand better collateral. They say no more often. And when many dealers do this at once, liquidity freezes. This isn't a theory. This is math. It's leverage meeting reality. It's collateral meeting panic. It's trust meeting a wall. And when the wall appears, people discover a brutal truth. The safety nets are not there to save you. They're there to save the system. Big difference. Let's talk FDIC. Yes, it exists. Yes, it insures deposits, but it's capped, generally up to $250,000 per depositor, per insured bank, per ownership category. That is not unlimited. That is not your whole life savings. That is a ceiling. Think like an adult. Most people didn't build wealth to sit under ceilings. They built wealth to live, to retire with dignity, to help kids, to stay independent. A cap is not dignity. It's a line in the sand. And when fear spreads, people don't calmly ask, am I under the cap? They ask one question. So can I get it today? And if everyone asks that at once, the system can't deliver. Because banks don't keep your money in a vault. They keep a fraction. They lend the rest. That's not conspiracy. That's the model. Now SIPC, yes, it exists. Yes, it has limits too. Often up to $500,000, including $250,000 for cash. And it's not protection from market losses. It's protection against missing assets and a brokerage failure. Different thing, and again, caps, always caps. Because these are designed for isolated failures, not for crowd running at once. A liquidity freeze is a crowd event, a stampede. And in a stampede, the first people out keep their dignity. The last people learn what the fine print really means. Now comes the trap. The freeze is the symptom. The response is the trap. And the response is always control. They don't admit failure. They manage behavior. They manage exits. They manage withdrawals. They manage you. First they deny, then they soothe, then they blame, then they restrict. Soft at first, then tight. And the tight part always arrives on a weekend. Quietly, when you're watching football, when you're with your grandkids, when you're not looking. Because the system loves the weekend, a stability weekend, a nothing to see here weekend. Then Monday morning, new rules. Imagine this. You open your bank app. A banner appears. Transfers may be delayed due to market conditions. Delayed. That word is poison. Delayed means permission. Delayed means your money is behind a gate. Imagine this. You try to withdraw more than the daily limit. The teller smiles. The smile is dead. We can do a smaller amount today. Not because you asked for a loan, because you asked for your own money. Imagine this. You go to buy gas. Your card declines. Not because you're broke, because the system is reviewing unusual activity. You call, you wait, you get a script. Temporary measures. Temporary. Like a storm that never ends. Imagine this. Your pension lands in your account. But the prices move first. Groceries jumped again. Insurance jumped again. Utilities jumped again. Your fixed income is fixed. Their prices aren't. So your retirement becomes a slow drain, a controlled burn. And while you struggle, the system sells you a solution. More tracking. More control. More digital rails. Programmable money. Central bank digital money. They'll call it modern. They'll call it safe. They'll call it efficient. But in a crisis, efficient means controllable. It means they can throttle what you do. They can slow transfers. They can set limits. They can flag purchases. They can freeze accounts for safety. And the sleeping herd will accept it. Because fear makes people beg for chains. They'll trade freedom for comfort. They always do, but you're not here to sleep. You're here because you can smell smoke. So what breaks first? Usually the plumbing, not always stocks, not always real estate. Often the bond market's smooth functioning. Overnight funding, the calmest market suddenly acting like a cornered animal. Then a big intermediary, a fund, a dealer, a clearing member, some name you've never heard, until it's on every screen. And then the simplest break of all, your access. Not your paper wealth, your access. Because the easiest valve to close is the one attached to you. They can survive your pain. They can't survive mass exits, so they slow exits. That's the trap. Now the exit, the real one. Physical gold and physical silver, not as a trade, as survival, as freedom, as bearer assets. A bearer asset doesn't need permission. No middleman, no server, no clearinghouse behaving. It's value in your possession. And that matters because the killer in a freeze is counterparty risk. If your wealth sits in a bank, you rely on the bank. In a brokerage, you rely on brokers, custodians, settlement, regulators. In a fund, you rely on a chain of promises. Chains break. And when they break, they don't break politely. They break with gates. They break with halts. They break with new policy. They break with for your protection. Metal removes links. It shortens the distance between you and your wealth. It is final settlement. That's why central banks hold gold. Not for romance, for reality. Because it's nobody else's liability. Because it's there when promises aren't. Now, the sleeping herd will mock this. Let them. They mocked inflation until it hit their cart. They mocked banking stress until they saw lines. They always mock lifeboats while the deck feels steady. Then the tilt comes, and then the doors lock, and then they beg. If you're 55 out plus, you don't have decades to rebuild from a trapdoor. You built this with your life. You don't gamble it on overnight funding and political promises. You position. You prepare. You keep enough cash for bills, but you stop keeping your entire future inside a promise machine that can rewrite rules mid-game. Because a 10% price swing is discomfort. A liquidity freeze is captivity. And here's the mindset shift. Gold and silver aren't about getting rich. They're about staying free. They're about being able to say no. No to delays, no to gates, no to permission, no to the system using your savings as a shock absorber. When you hold metal, you can wait. You can choose your moment. You can avoid being forced to sell into widening spreads. You're not trapped at the casino table while the house changes the odds. And make no mistake, this system is a casino. Bright lights, pretty charts, smiling experts. They hand you chips and call them assets. They promise you can cash out any time. But every casino has one rule. When the house is threatened, the house changes the game. They can slow withdrawals. They can shut down tables. They can halt trading. They can suspend for volatility. And they can do it legally because you agreed to it. You clicked accept. You signed the forms. Gold and silver are walking out with value that doesn't need the casino. That's why we call it being your own central bank. Not because it sounds cool. Because it's the only way to remove a politician, a banker, and a broker from between you and your purchasing power. Now, I want you to lock these three signals into your mind as we move forward. Emergency oxygen, widening spreads, delivery strain. When you see them rising together, the message is clear. Dealers are maxed out, balance sheets tight, funding tight, collateral demands rising. And when the shock hits, something snaps. So act before it snaps. Not in panic. In clarity. Reduce exposure to promises. Add exposure to possession. Move valuables to higher ground before the flood hits the door. Because once the water's inside, you don't negotiate. You drown. And don't get confused by the word metal. This isn't about collecting. It's about capability. Gold is the anchor. Dense. Compact. A way to store serious value in a small space. Silver is the daily tool. The small bills. The kind of metal you can use in smaller trades if things get ugly. Not because you want the world to get ugly, because you refuse to be helpless if it does. Imagine this. Your internet is out. Your phone is dead. The card reader at the store is offline. And people argue at the counter. A clerk shrugs. You don't need a speech, you need a solution. That's what bearer assets are. Solutions. Now, if you're thinking, I'll just buy a paper proxy. Stop. Paper gold, paper silver, ETFs, unallocated accounts. Those are still promises, still counterparties, still gates. In a freeze, paper can trade while physical is delayed. Paper can be settled while delivery is rationed. paper can look liquid while reality is tight. And when you need it most, the promise chain can stretch or snap. Physical doesn't stretch. It just sits there. Quiet, patient, honest. That's the whole appeal. It doesn't require anyone's mood, anyone's solvency, anyone's permission. It's you and what you hold. That's why this matters most to retirees. Because retirement is not about maximum return. It's about maximum control, maximum certainty, maximum dignity. And notice how they talk when trouble hits. They say, stay calm. They say, do not withdraw. They say, trust the process. But that's not advice, that's crowd control. Because if you stay calm while they change the rules, they win. So you do the opposite of the herd. You prepare while it's boring. You build a lifeboat while the sea looks flat. You spread your risk instead of stacking it. You hold part of your wealth where it can't be frozen by a click, because a click is all it takes now. If you want to survive what's coming, subscribe to Bull and Bear. Not for entertainment, for warning, because the next phase won't arrive with a siren. It'll arrive with a quiet lock on a door you assumed was always open. Final thought. When the system runs smoothly, everyone feels smart. When the system freezes, only the prepared sleep. Promises are easy. Possession is power. Be the one holding power, not the one holding a receipt.